Most people work for money, but the ultimate goal of dividend investing is to have your money work for you, creating a stream of income that hits your bank account while you sleep. Imagine a life where your expenses are covered by the companies you own. However, there's a massive gap between the get-rich-quick stories you see online and the reality of what it takes to actually live off these payments without going broke. It requires more than just picking a few stocks. Today, we are doing a deep dive into the real numbers for 2025. We're stripping away the lies and looking at the capital, the taxes, and the risks that nobody wants to talk about. This is the truth about dividend retirement. To start, you need to understand the fundamental math. If you want $60,000 a year and your portfolio yields 3%, you need $2 million. It's that simple and that daunting. The yield determines the price of your freedom. In today's market, dividend yields are compressed. The S&P 500 is yielding near historic lows, meaning you need more capital now than ever before to generate the same income. Growth has outpaced payouts for years. We've broken this down into 3 realistic scenarios: the lean lifestyle, the average retiree, and the comfortable dream. Each represents a different level of sacrifice and portfolio size. Let's look at the numbers. Scenario 1 is lean living. At $40,000 a year, you're covering the basics. At a safe 3% yield, you need $1.33 million to make this work safely without touching your principal. Next is the average retiree, spending about $65,000 annually. To fund this lifestyle purely through dividends at a 3% yield, your target is $2.16 million. This is the benchmark for most American households. Finally, the $100,000 dream. This provides true comfort and the ability to travel. But at a conservative 3% yield, you're looking at a staggering $3.33 million in capital. At this point, many investors make a fatal mistake. They start chasing high yields. They see a stock paying 10 or 12% and think their problems are solved. In reality, they are walking a dangerous tightrope. A dividend is only as good as the company's ability to pay it. Often, a double-digit yield is a warning sign that the stock price is collapsing or a dividend cut is imminent. If that happens, you lose your income and your principal simultaneously. Even if you hit your capital target, you're not done. You have to account for taxes. Qualified dividends are taxed at lower rates, usually 15%, but that's still a massive chunk of your living expenses you must plan for. If your income comes from REITs or certain bond funds, you're paying ordinary income tax rates. This can reach up to 37% depending on your bracket. You must overfund your portfolio just to stay even after the IRS takes its cut. Then there's inflation. If your dividends stay flat while prices rise, your lifestyle will slowly erode over the next 20 years. This is why yield alone isn't enough. You absolutely need dividend growth to survive. Enter the Dividend Aristocrats. These are companies that have increased their dividends every single year for at least 25 years. They are the backbone of a sustainable dividend portfolio because they've proven they can grow in any economy. With these companies, you aren't just getting a check, you're getting a raise every year. This growth is what protects you from inflation and allows your income to outpace your spending without selling a single share. This leads to the secret weapon: yield on cost. If you buy a stock today at a 3% yield, but it grows 10% every year, in a decade, your effective yield on your original investment could be over 7%. Time is the multiplier. Picking individual stocks is a full-time job. For most, dividend ETFs like SCHD or VYM are the answer. They provide instant diversification and professional management for a tiny fee, allowing you to focus on your life instead of spreadsheets. Diversification is your only free lunch in investing. By owning hundreds of dividend-paying companies at once, you ensure that one bad quarter at one company doesn't destroy your retirement. It's about building a shield for your income. The hardest part isn't the math, it's the psychology. When the market crashes and your portfolio value drops by 30%, will you have the stomach to hold and keep collecting those dividends? Most people panic and sell at the bottom. The best dividend investors view a market crash as a fire sale. They focus on the income stream, not the daily price fluctuations. That's the mindset required for long-term success. If the dividends are paid, the market price doesn't matter. So how do you get there? You start during the accumulation phase. This is where you reinvest every single cent back into more shares using a dividend reinvestment plan, or DRIP. You are building your machine brick by brick. Early on, your dividends might only buy 1 or 2 shares, but over decades, this creates a snowball effect that accelerates your path to that $1 million target. The more you have, the faster it grows. It's pure physics. Many compare dividends to rental income. While rentals offer leverage, dividends offer true passivity. No tenants, no leaky toilets, and no property taxes. It is the cleanest form of cash flow known to man. Not all dividends are the same. Real estate investment trusts, or REITs, are required by law to pay out 90% of their taxable income to shareholders. They offer high yields but carry unique risks related to interest rates. Utilities and business development companies also offer unique income opportunities. A balanced portfolio mixes these high-yield sectors with lower-yield, high-growth consumer stocks to ensure stability and longevity. In 2025, many are using covered call ETFs like JEPI to boost their current income. It lowers the capital needed, but it's important to know you're trading away your future upside for that immediate cash flow today. Know the trade-off. Is dividend investing better than just selling shares of growth stocks? It's a debate that never ends. But for many, the psychological comfort of a check that arrives regardless of market price is priceless. It removes the fear of selling at a loss. The famous 4% rule suggests selling principal. Dividend investors aim to never touch the principal. This luxury strategy requires more capital up front, but provides a much higher margin of safety for a long retirement. Your portfolio isn't set it and forget it. You need to prune companies that lose their competitive edge or stop growing their payouts. Constant vigilance is the price of total financial freedom. You are the CEO of your own fund. Don't limit yourself to one country. International dividends can offer higher yields and currency diversification, protecting you from a downturn in any single economy. The world is full of companies that want to pay you. One of the greatest benefits of this strategy is the legacy. Since you never touch the principal, you can pass a cash-flowing machine down to the next generation, creating true generational wealth that can last for decades. Let's review the real numbers. 1.3 million for a lean life, 2.1 million for average, and 3.3 million for total comfort. These are the honest numbers you need to target for 2025 and beyond. The journey to $3 million starts with a single share. Don't let the large numbers discourage you. Let them motivate you to start today. Time is your greatest asset in the world of dividend investing. Just start. The path to financial freedom is paved with patience and dividends. Stay disciplined, keep learning, and your future self will thank you for the checks you start collecting today. Thank you for watching this deep dive.